Our global strategy is different from other global equity products. We focus only on market leaders with strength across 5 key factors that make these companies growing faster in terms of earnings compared to the rest of the market. We look at these factors and we analyze these companies using our proprietary research team and our proprietary research analysis. We look at the financing capabilities, at the product development, at the innovation, the competitive cost structure, the brand recognition, and lastly, the marketing power that these companies have and will maintain over a long period of time.
We initially screen for companies that have a market capitalization above $10 billion. The secondary screen that they have international revenues of more than 25% of their total revenues. And we further check that they are industry leaders. We then score the companies 1 to 5 on 4 factors, 1 being poor, 5 being excellent. The 4 factors are brand, consistency, defensibility, and finally valuation. The total score is then taken into account along with analyst recommendations to create a portfolio of high quality companies with leadership positions and the capability to reinvest and deliver exceptional long-term growth relative to their peers. We take GlaxoSmithKline, or GSK as it's commonly known, a leading UK pharmaceutical company. It's been through a major transition. Historically, it was perceived to be a poor company with bad R&D productivity and an over-reliance on the US market. We therefore weren't invested. However, in 2015, it did 3 major deals. It sold its oncology division for a significant sum, $16 billion. It also swapped that asset to buy in vaccines business and a consumer business from Novartis. This changed the outlook for the company. The new business is more sustainable and with leadership positions. Therefore, we believe that over the next 3 to 5 years, they'll deliver better growth with less competition. This has not been reflected in the valuation. In addition, we believe the new CEO is going to improve pharma R&D productivity and reduce the amount of money that's spent on poor R&D. Therefore, the returns should improve and the long-term growth should improve, and this is not yet reflected in the valuation.
Yeah, we don't look only at consumer-recognized companies with consumer-recognized brands. We also look at companies that are operating more in the business-to-business areas. One of the companies that we have in our portfolio at the moment is Marsh McLennan. Marsh is listed in US. It offers a client's advice in risk solution, in HR, and in the advisory of strategy. Some of its brands in these areas are Mercer, Oliver Wyman, particularly in the advisory, and Marsh in the insurance broking in the US. We believe that Marsh McLennan can maintain a very high ROE in the mid-high 20s for a long period of time, thanks to certain characteristics that the company has. In particular, the strong focus on efficiency, their acquisition strategy of bolt-on M&A that can create value for shareholders, and also on focusing on innovative areas like cyber insurance or digital insurance, which are 2 areas of risk that are emerging due to the new technologies, where the companies operates and has a leading position in the brokerage of this type of insurance risk. In terms of valuation, we have still an attractive valuation with a double-digit upside compared to the current price, and also the company scores very well with our total scoring based on the characteristics that we look for these companies, which makes us feel comfortable that together with the high ROE and the compounding effect that this can have, the company presents a very interesting opportunity and a good position to have for our fund.
We're seeing a synchronized recovery across the economy globally. We're seeing confidence picking up, and we're seeing companies reinvesting and mergers and acquisitions taking off. We believe there's more value in Europe than the US. The US has rallied in anticipation of reforms following the election of President Trump. These include healthcare reform, tax reform. However, we believe this legislation could be more difficult to actually enact, and that once the clearing event of the French election occurs in the next couple of months, that the European stocks could outperform their US peers, although we still see some pocket of value within the US.
We know there are very good preconditions for the equity market for 2017. We know also that the market remains volatile and there are still risks there. And we will do all our best to have a good performance in all these different market conditions.
Please trust us to buy your slice of global major players to drive future growth.